let's talk about cash. It's the absolute lifeblood of any business, right? But here's the catch. It's also your single most vulnerable asset. I mean, it can literally walk right out the door without a trace if you're not paying close attention. So, how do you protect it? How do you lock it down? Well, that's exactly what we're going to dive into.
Hello, everyone. Before we get started, I just want to mention that this explainer was prepared by Samir El-Rashani, PhD, with AI support.
So, here's our game plan for today. First, we'll get into exactly why cash is so risky. Then, I'm going to introduce you to a really powerful 5-part framework for protecting it. From there, we'll see how that framework works for money coming in and then for money going out. And we'll wrap it all up with the key takeaway that you can put to use right away. All right, so let's start with a big question. Why all the fuss about cash? I mean, a business has lots of assets, right? Buildings, inventory, equipment. But here's the thing about cash. It's the most liquid, the most desirable, which unfortunately makes it the absolute easiest to steal or even just misplace.
And when we say cash, I want you to think bigger than just the bills and coins in a drawer. The rule of thumb is this: if a bank will accept it for deposit, you should treat it as cash. That means we're talking about currency, of course, but also checks, money orders, the whole shebang. All of it needs to be protected.
Okay, so how do we actually build a fortress around our cash? Well, it's not about bricks and mortar. It's about having a smart system. The answer lies in a framework of 5 core principles of internal control. I want you to think of this as your universal toolkit for cash security. And here they are, the big 5: assignment of responsibility, segregation of duties, documentation, physical controls, and finally, review and reconciliation. Now, the key thing to remember is that these don't just work on their own. They're designed to be an interlocking system. They support each other. This is the foundation for everything else we're about to cover.
All right, enough theory. Let's get practical. We're going to start by taking our 5 principles and applying them to cash receipts. And that's just a fancy way of saying all the money that's coming into the business, whether that's from a customer paying at a counter, a check that arrived in the mail, or an electronic transfer.
First up, principle number 1, assignment of responsibility. This one is all about clarity. You've got to know who is in charge of what. You have to assign responsibility for every cash handling task to a specific person. When everybody knows exactly what their job is, you automatically build accountability right into your process. So what does this look like in the real world? It means only certain people, designated authorized employees, should ever touch the cash. Let's take a retail shop, for example. The cashiers, they handle the transactions all day. But at the end of the shift, maybe only the supervisor has the key to the register to do the final count. That's a perfect example of a clear assignment of responsibility. It's layer 1 of our defense.
Let's move on to our second principle. And folks, this one is absolutely crucial: segregation of duties. The big idea here is simple but powerful. You never ever give one person total control over a financial process from start to finish. It's the ultimate check and balance.
The key is to separate the physical handling of cash from the recording of that cash. For instance, imagine you get checks in the mail. The person who opens the mail and makes a list of all the checks that came in should be a different person than the one who actually takes that money and prepares the bank deposit. That simple separation makes it so much harder for any funny business to go unnoticed. Principle number 3 is documentation. Listen, if there's no trail, no paper trail, no digital trail, then for all intents and purposes, it's like the transaction never even happened. Good documentation is your proof. It's the evidence that shows everything was recorded correctly and the cash ended up exactly where it was supposed to go. This is why things like cash register tapes, deposit slips, and point-of-sale system reports are so important. Let's picture a busy food truck. Their POS system, that little tablet they use, it creates a digital record of every single taco they sell. So at the end of the night, the amount of cash in that drawer has to match the number on that digital report. No exceptions. That report is the proof. Okay, now we get to the one that feels most like old-school security: physical controls. This is all about safeguarding the cash itself, with actual physical barriers and smart procedures. It's basically about making the money physically difficult for an unauthorized person to get their hands on. This covers the obvious stuff, right? Using safes, using cash registers with locks. But a really key procedure here is depositing all your cash in the bank daily. Leaving a big pile of cash on site overnight is just asking for trouble. A great real-world example is a retail store that empties its registers every single night and puts all the cash into a locked drop safe that only the owner or a highly trusted manager can get into.
And that brings us to our fifth and final principle, the one that really ties this whole system together: review and reconciliation. Think of this as the verification step. This is where you double-check to make sure all your other controls are working like they should, and that, at the end of the day, the numbers actually add up. So this means having supervisors count the cash every day. It means having an accountant compare the total amount of receipts you recorded with the actual bank deposit records. For example, imagine a bookkeeper whose first job every single morning is to log into the company's online banking, pull up yesterday's statement, and hold it right next to the deposit slip from the day before. If those numbers match perfectly, the system is working.
Okay, so we spent a lot of time talking about how to protect the money that's coming in, but what about the money going out? Well, here's the beautiful thing about this framework. The exact same 5 principles apply to securing your cash payments, too. See? It's the same 5 principles, just pointing in the other direction. We're still using responsibility, segregation, documentation, physical controls, and review. So let's just quickly run through how this amazing framework protects your cash when it's leaving the business, which these days is usually through electronic payments or checks. It works just like you'd expect. First, assignment of responsibility. You designate specific people who have the authority to approve payments. Second, segregation of duties. The person who approves a bill for payment is not the same person who actually logs in and sends the money. Third, documentation. Every single payment going out must be supported by an approved invoice. No invoice, no payment, period. Fourth, physical controls. This is often digital now. Think about things like requiring multi-factor authentication to get into the online banking system. And finally, review. You regularly reconcile the payments that actually left the bank with the list of payments that were authorized. See, it's the same powerful logic, just protecting the cash going out. So there you have it. We've walked through the why, the what, and the how. We've built a complete 5-part framework for protecting what is arguably the most vital asset in any business. Now, there's just one final step, and that's turning all this knowledge into action.
So I want to leave you with a question. I want you to really think about your own environment, your business, your department, maybe even just your personal finances. Of these 5 principles we talked about, assignment of responsibility, segregation of duties, documentation, physical controls, and review and reconciliation, which one is your weakest link? Because finding that weak spot, that's the very first step to building a truly secure system.